Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and in today's video, we're going to be taking a look at 3 different REITs to buy now after the Fed recently announced rate cuts. Now, if you do enjoy this type of content and appreciate the transparency, consider subscribing to the channel. It would help me out a ton. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. Now, before we get into the 3 different companies, let's take a look at my portfolio dashboard. In total, I've invested $53,538, and my portfolio value sits right under $74,000 with an over $20,000 gain, or almost a 38% total return. Now, a lot of that performance has come recently, and it's actually been driven by one of my largest positions, Google. In terms of dividend income, I've earned over $2,000 in dividend income, which has been reinvested back into the companies that paid it out, and going forward, my yearly projected income is $1,120. Now, this is my main taxable account, so I focus on lower yielding stocks, which gives me a portfolio yield of 1.52%, but I also have a Roth IRA, which holds some of these REITs that we're going to be taking a look at today, and over there I have higher yielding positions to take advantage of those tax advantages. Now, I do want to preface by saying that this video is going to be a little bit more brief than some of my other stock analysis videos. We're basically just going to be taking a look at price performance as well as some financial metrics for each of these companies. So if you guys have any questions that I didn't get to in this video, make sure to leave them down in the comments below and I'll be happy to get to them. Now, with that being said, let's start by taking a look at realty income. And for every single stock we're going to be taking a look at today, I'll give you guys my thoughts on the company itself, whether I hold any shares, and if it's a buy, hold, or sell right now. So the first company here is Realty Income, and you can see its price performance right here, but we'll take a better look at the price performance on Google Finance. So taking a look at price performance in the past 6 months, it's up almost 5%. Year to date, it's up 12.5%. In the past year, it's actually down 4%. In the past 5 years, it's down about 2%. This doesn't include the dividend income that's coming in at almost 5.5%. So the main reason that we've seen such poor performance in the past couple years from Realty Income, and also this is going to stand true for the other 2 companies we're going to take a look at today, and any other REITs you guys might be focusing on yourself, is because of the higher interest rates that we have had for the past couple years. These real estate investment trusts take on a lot of debt in order to leverage and acquire more properties, and as interest rates go up, it's harder for them to take on more debt without taking on too much risk. Also, higher interest rates make it so that their payments on that debt is even higher than before, so refinancing is difficult, and their monthly payments are higher than expected, which makes it harder to break even or make a profit on certain positions. So what a lot of these companies have been doing for the past couple of years is actually diluting shareholders by selling more of their shares, so it creates more shares outstanding and therefore dilutes the shareholder. Now, this is a good tactic in order to still be able to acquire properties at good value without having to take on more debt, but it's also a little bit risky for the shareholder if their AFFO or their adjusted funds for operation don't go up over time. Now, my main thesis for REITs, and the reason I actually hold some of these in my Roth IRA, is because I do believe that over time, as interest rates come down, they're actually going to have some pretty strong performance, at least for a couple of years. So we will take a look at the price performance for all these companies, but in my opinion, it doesn't matter too much. Past performance is not indicative of future results, and I actually believe they have a big opportunity to make a lot of gains in the next couple of years. So hopping into the financial metrics, the main thing we can see here is the revenue per share has been increasing over time, and the earnings per share have actually remained pretty flat over the past couple of years, but their free cash flow has been able to increase by just a little bit. Now, in terms of shares outstanding, this is the dilution that I was talking about. Basically, in order to acquire more properties, they're diluting shareholders by releasing or selling more of their shares. That's how they raise capital for these big acquisitions. Now, for most companies, it's something that I think is very detrimental to them, but for REITs, it's a very common tactic and definitely not out of the ordinary. And the main thing we have to take a look at is if AFFO per share is growing over time. Now, unfortunately, on this spreadsheet, I'm not currently tracking AFFO per share, but we can jump into Seeking Alpha to just verify that real quick. So jumping into Seeking Alpha, you can see 2 different metrics here. We have AFFO and we have AFFO per share. And the main thing we want to look at here is AFFO per share because they've been diluting shareholders. If the shares outstanding remain stagnant, then we can actually just use AFFO, but because they have been diluting shareholders and selling more of their shares to the open market, then we should be using adjusted funds from operation per share. So here you can see that the growth is slower than the regular AFFO, but that's perfectly fine because over time it is still growing. Now, for the other 2 companies today, we're not going to be taking a look at their AFFO, but if you guys want to take a look for yourself, just hop into Seeking Alpha and pull up this metric. So hopping back into the financial graphs, we can see that their free cash flow over time actually has been growing, and their stock-based compensation is extremely low, so nothing to worry about right there. Then we have their dividend per share. This is not accurate. They've actually been paying dividends every single year since their IPO, so that's a pretty impressive stat. And they're actually the monthly dividend company because they pay monthly dividends. They recently announced another small dividend hike, and they tend to do a couple of these per year. Now, if you guys want a more in-depth analysis on realty income, I'll actually pin a video up here where I cover it extensively, but I have several videos on the channel featuring realty income specifically to go into more depth. Now, for my opinion on the stock, for me, it is currently a hold because I already own a very sizable position, but if I did not have a position in the stock right now, I would actually be building a position even at these prices. I think at $59 a share, it's a pretty fair valuation, and I think over the next couple of years, I'm going to be seeing a lot of growth from this REIT. So the next company I want to cover here is American Tower Corporation, and it's an American real estate investment trust which owns, develops, and operates wireless and broadcast communication infrastructure in several countries. Now, what I want to note here is that even though all the companies I'm showing you today are REITs, they're all in different segments. The first company that we cover, Realty Income, specializes in triple net leases to customers like Dollar General, Walgreens, and CVS, whereas American Tower Corp actually leases broadcast communication related infrastructure. Now, the last company we're going to feature in today's video is more of an industrial REIT, so there's still ways to get diversification even within the same sector. So in the past 6 months, the company is down 10%. In the year-to-date period, it's up 6.78%. In the past year, it's down 17.76%. In the past 5 years, it's down 21%. Now, what you can see up here is actually their 10-year performance, which has been pretty strong, but in the past couple years, they've really been struggling. The revenue per share has been going up, but it has slowed down significantly over the past couple years. The earnings per share has been a little bit all over the place, and the same thing can be said for their free cash flow per share. Now, just like Realty Income, their shares outstanding are going up, but it's a much more manageable rate. They're mostly not releasing too many shares per year, which I like to see. Now, in terms of free cash flow and stock-based compensation, I'm not worried about the stock-based compensation amount, but it is a slightly larger amount compared to free cash flow for Realty Income, but it's still not bad at all. Now, what I really want to point out here is how quickly their dividends have grown. They used to be doing double-digit increases almost every single year. In the past year or two, we have seen a slowdown in that, but I think the company is still fundamentally very strong. They have pretty high net income margins, but they also have much higher capital expenditures because they have to build up a lot of this infrastructure themselves. Now, for my opinion on the stock, I do own this one in my retirement account as well, though a smaller position in order to manage my risk. I actually think it has more risk inherent to it than Realty Income does, but I still think it's a strong company. Now, at $193 per share, it's actually trading really close to the price that I initially bought it at, so I'm definitely considering adding more into my position, but I'm at minimum holding my position right now. Now, if this price does continue to trend down over the next couple weeks, there is a very good chance I'll add to my position, but we'll just have to wait and see. Regardless, I think it's trading at a pretty reasonable valuation, and I think it's a buy right now if I didn't already have a position in it. Now, the last real estate investment trust that I want to cover in today's video is Rexford Industrial Realty Incorporated. Now, this REIT is focused on acquiring, owning, and operating industrial properties in infill markets of Southern California. What I like about the company is that it does fill a niche in my portfolio that I didn't previously have, which gives me just more diversification and more safety long term. In the past 6 months, it's up 4%. In the year-to-date period, it's up almost 10%. In the past year, it's actually down 18%. And in the past 5 years, it's down 7.84%, so some pretty poor performance. Now, something I neglected to mention earlier in the video is the company's dividend yield. So this one is 4.1%, but the previous ones also had some fairly substantial dividend yields, with American Tower Corp being the lowest dividend yield. A good thing about REITs and what many people buy them for is their dividend income, especially towards retirement. You want higher dividend income a lot of times to be able to live off of it. Now, at my current stage, I don't care about dividend yield for the reason of income producing assets, but I do care about dividend yield if I think the company is trading at a good valuation. I can get a very good starting dividend yield. Over time, as I reinvest these dividends, it'll help me compound my gains at a quicker rate. So in terms of their financial metrics, this is the 10-year graph as well. You can see it actually did perform pretty well. At the peak, it was actually up pretty significantly, but since then it has a pretty massive drawdown. The revenue per share is increasing very quickly, even over the past couple of years, though going forward it's expected to slow down. The earnings per share and the free cash flow have also increased quickly, but the free cash flow is down in 2023 and 2024. Now, one way that they have been increasing their earnings significantly is through acquisitions, and they've been diluting shareholders pretty aggressively over the past couple years, which is not my favorite thing to see, even though it is sometimes necessary. Now, the other concern with this company, and it being a smaller company overall, is their stock-based compensation is very large and makes up a massive portion of free cash flow. This is definitely something that I keep in mind when investing in a company like this, and that's why it's my smallest position out of the 3 REITs by far. I think that the company has bigger upside potential because of its faster growth rate, but it also has bigger drawdown risk because of how much stock-based compensation, how much dilution is going on. Regardless, over time, they have been increasing their dividend per share nicely, which I'm happy to see, but their capex has basically exploded over the past couple of years, which is something that I have to keep my eye on going forward. In general, I think Rexford is a pretty high quality company, though definitely the riskiest of the bunch. At the current price of $42 per share, I'm going to be holding onto my position, but not adding any more unless there's a significant drawdown going forward. In the current economic environment, I think Rexford Industrial Realty is actually a hold, but if interest rates begin to fall dramatically over the next year or two, I think it's a buy. As always, that does bring us to the end of today's video. I really hope you guys enjoyed taking a look at these 3 different REITs and what I'm doing going forward after the Fed just announced an interest rate cut. If you did make it all the way to the end of the video, let me know down below whether you own any of these companies or whether you have plans to buy them in the future. If not, just let me know what companies you're buying now. I'd love to know. If you haven't yet watched last week's video where I did a stock spotlight on Adobe stock, check out this video right here. And if you want to see how much dividend income I earned in the month of August, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.